Hi, everybody. Thanks so much for coming to Widening Access to Capital in Developing Markets. This is going to be a fantastic panel. You know, I run the Center for Financial Markets at the Milken Institute. And when I think about widening access to capital, I think about it in three different ways. First is attracting foreign investment to a developing country's economy. And I think that's the traditional way that people think about this. Secondly is to bring in financial inclusion to folks that are not part of the formal financial sector. And I think that's also a way that people think about it. But third, to make sure that we are tapping into domestic sources of savings. And that's equally important. So as important as attracting FDI is developing capital markets in developing countries to tap into sources of finance for corporates and also better savings vehicles for investors. And so that's a large part of the programmatic work that we do at the Milken Institute in my center. And I am thrilled to have an esteemed panel up here with me to discuss these topics. Let me start on my right with Afsaneh Beschloss, who, if you are a woman and you work in finance and you care about developing markets, she's basically your hero, right? You kind of, you want to be her. You can't be her, but you want to be her. She is, of course, the founder and CEO of the Rock Creek Group. Before that, the CIO of the World Bank, referred to by the president of the World Bank as my boss constantly. Then, of course, did a stint at Carlyle, and I cannot mention her board appointments because that would take up the entire hour. To my immediate left is Ermias Eshetu, who is the CEO of the Ethiopian Commodities Exchange. And this is, if you know something about this, or even Africa capital markets at all, the shining light is the Ethiopian Commodities Exchange. They built it from almost nothing, and it's really an important model now for the continent. Next to him is my good friend, I'm happy and pleased to say, the Honorable Minister of Finance, Claver Gatete of Rwanda. I've known him for a very long time, back when he was the central bank governor. Before that, of course, he was the ambassador to Canada. So he's just rotating in every position in the government. So next year, you'll see what they tap him to do maybe next year. And of course, my partner, my friend and partner, Jingdong, who is the treasurer of the International Finance Corporation, and kind of a life-changing event when I first met him. He's very much of a forward thinker about developing capital markets and a pretty entrepreneurial guy himself, I have to say. So, with no further ado, let me start, Jingdong, with you. You are, at the IFC, as everybody knows, responsible for financing the private sector in developing countries. So, what do you care about developing capital markets, actually? These countries can just go to the IFC for some money and be done with it. So tell me about how you think about the world and why you think it's important to do more than your day job.
Thank you, Staci. I wish it were that easy, yeah? Because when you approach a typical investor from OECD countries, you offer the investor a port project in Australia without even thinking. The investor would say, I'm in. And if you say, oh, I also have a port in Mozambique, then the investor would say thanks, but not thanks, yeah, without even understanding, the actual situation. So what I would say is that when we describe emerging market, it includes the 120 countries the United Nations would define. And last year, 2015, was a pivotal year in the sense that the UN has defined a new sustainable development goal, and there was COP21 on climate change. But the international community finally realized that we need trillions and trillions of dollars. Governments are so indebted, to add more debt to government is not sustainable. So I think for the first time, the development finance community of the world in Addis Ababa last year recognized the centrality of private sector and private sector investment in playing that critical role. And therefore, it's only natural, as Staci mentioned, the three angles of financing, right? Foreign investment, financial inclusion, and efficiently recycling domestic saving in all three, capital market plays a critical role. So let me stop here, and we can elaborate further on.
Okay, terrific. Minister, Rwanda is not the biggest country in the world. Why do you think that you could even aspire to have capital markets? Aren't you too small? You don't even have the economies of scale required to do capital markets. Why do you think that this is important or even possible for you?
Yeah, thank you very much. I don't think there's any country that is very small when it comes to money. Look at Singapore. Just to say, first of all, let me agree with my colleague here. For a long time, for countries like ours, we've been relying more on government spending, on government investment. And if you're looking at the long-term sustainability development, the private sector is a very critical, has a critical role in this. But most of the private sector in our developing countries have been relying on deposits of ordinary people in the banking system, and have really less access to the international resources, especially from the private resources. And that's really the need where we need to make sure that we put the pieces together, the banking system, the insurance and others, but at the same time the long-term resources. And for those long-term resources, you can't do it without having a capital market. That capital market really is the only vehicle that attracts resources, whether internally or in the region or even globally. In our case, what we saw in the East African Community region is that we are creating the capital markets, but not just only individual capital markets for each country, but we are trying to see how we link up the ones for East Africa. For example, the Rwanda, Uganda, Kenya, and Tanzania, and now we are working on terms of linking the capital market so that the trading and also the investment can be for the region, coming from the region, but also coming from outside the region. And we are trying to see how we can harmonize the regulations, the corporate governance, the payment system. We have already introduced the East African payment system. We are now working on linking the trading platforms so that we can be able to trade across the region. And this becomes even more attractive, in as much as Rwanda, of course, itself needing resources, depending on how efficient you work, we can attract money, but at the same time for us, the region is very, very important.
Jingdong, let me go back to you actually and ask you, as you work in these countries, you issue domestic debt. How have you found the capital markets, and how have you found the road going for the IFC? And maybe talk a little bit about that to kind of set the broader narrative.
Yeah, I think following your question to the Honorable Minister, I would say size doesn't matter. When you look at Singapore and Hong Kong, two pieces of rocks where they developed the most sophisticated financial infrastructure, transparent legal framework, and therefore they are able to play a role much bigger than the size of the country. I think Rwanda is certainly a shining example of that. So indeed, for the past decade, I have been traveling to emerging market countries and trying to encourage policymakers, national leaders to pay attention to capital market development. But I think especially for countries where it's a democratic system, developing social infrastructure, welfare, education, and physical infrastructure, which is, power stations, roads, these are much more the preoccupation of policymakers. And when it comes to financial market and capital market, normally it is not put as a priority. Now, one of the conversations we always have is really to say that, look, the United States didn't develop relying on foreign capital. The United States developed when their real economy and the Wall Street were working in tandem. And you develop a virtuous cycle so that you can connect your savings to your productive investment very, very efficiently. And there is a second angle is with the super cycle of commodity ending, you see a lot of emerging market currencies, really dropping, right? So IFC being an international AAA, I have to say 2-3 years ago, I go to a country, the local entrepreneurs who, otherwise produce local currency revenue, they would tell me, Jingdong, I prefer to borrow your dollar because your dollar is cheap, right? Because the nominal interest rate is very low. And now they are all regretting. They tell me I should have borrowed local currency. But they couldn't because there wasn't an efficient local capital market to provide that resources. So I think I have been very passionate in terms of advocating that three infrastructures have to be in place at the same time: physical, social, and financial infrastructure, and capital market is an integral part of it. And I think we have had very successful example in Rwanda, where within a year, the government was able to put in place a set of regulatory framework and market infrastructure, so an international AAA like IFC were able to go to the domestic capital market, issue the first ever local currency bond by a foreign entity. And that was leadership. And I think we should really replicate the success that we have had in Rwanda in many different countries.
Can I say something?
Absolutely.
He made a very important point. You see, I want to differentiate between the foreign direct investment, where a company comes, establishes in a country, starts business. For many private savers globally, they don't have that time. They cannot be in every country anytime. That's not their job. But they have money. And they have invested through the fund managers. And this money has to be invested. Now, this is quite a lot of money. And it needs a channel. It needs a framework. And that framework is a capital market. The reason for this is the point that he was making, is that when you are tapping this money, you are not borrowing. Actually, they are investing in that business, in local currency. You don't have to pay back in foreign currency, but at the same time, you have attracted this money. And it helps also in the balance of payments for us who are in the Ministry of Finance, who are trying to see how to maintain the macroeconomic stability. So it plays quite a different role in as much as it brings in the money, but at the same time, it also helps the country to make sure that we can sustain our development.
Yes, wise words for Zambia, Nigeria, South Africa right now, I have to say. So the only person, the person on the panel that's really getting the dirt under his fingernails on this capital market development, of course, is Ermias, the CEO of the Ethiopian Commodities Exchange. So why don't you talk a little bit about the philosophy of the exchange and what you're doing, and brag a little bit about what you've done.
I was just listening to what my colleagues were saying, and in Ethiopia, we're known to be a little bit more prudent when it comes to the financial sector, and it's been quite a challenge. I'm a banker myself, so over the last 10 years I spent building a technology bank in Ethiopia. So when we talk about capital market development and the infrastructure needed to that, it's not an easy job in places like Ethiopia and for the rest of Africa. Even employing the right kind of candidates for a very sophisticated operation like banking, it's not easily done. The infrastructure is a process. I would agree that it should be taken parallel to other social responsibilities. But for instance, what we've done in Ethiopia is, we built over 50 universities over the last 10 odd years. 50 brand new universities. Unless we get enough supplies of educated resources as part of the infrastructure, it's not going to be possible to be able to operate and run banks and so on. So now, it's been only less than 20 years since we liberalized the finance sector in Ethiopia, and we now have reasonably, strong local bankers, some 20 of them just getting off the ground. That aside, I think with the commodity exchange, the philosophy behind it was really, we operated in a very traditional mindset. Some 80% of Ethiopians live around a farm. We're talking about 100 million population, or approaching 100 million right now. So 80% means 80 million people. So that's part of the society is completely, they live near a farm, and when we talk about farms, this is a household farm, so they're very small sizes of farms, so it's not commercial size farm. So how do you make sure that these people are part and parcel of the economic development, the financial development, and so on and so forth? So this was a tricky part. In order for those people to become an active players in the economic cycle, we have to put more money in their pockets, and that means that they needed a market that is constantly growing and that provides a kind of a fair money back for their production.
Was there any market at the time?
No, absolutely not. This was all custom made for our own problems. It was a challenge. Actually, we have had help from IFC and other friends across the globe, but it was all local made. And Today, at the exchange, we have an ecosystem. We have a system where nearly 3.3 million farmers access the market through the exchange. And this is only the tip of the iceberg. We're just the beginning. It's only 8 years old. We're only trading coffee, sesame, and a few other oil seeds. But we're in the pipeline. I already have the mandate to start to work on futures and forward. We're looking at some exciting derivative markets in the near future. I would love to be listing some bank stock very soon. We have 20 odd banks, and I want to be listing those stocks at the exchange. So eventually evolving it the way it works for us. I think the challenge, though, is this is a developing market, and again, going back to the financial infrastructure, so, we're struggling with power every day. We're struggling with the human resources every day. So the speed of change is while we're introducing new products and services every day, the challenge itself is not easy to conquer in places like Ethiopia. Nonetheless, it's changing. We now have nearly 1,000 traders represented on the floor, and we only in October we introduced electronic trading. Again, people who are used to the traditional open cry. So we still have one open cry, and we just introduced electronic trading in parallel to it. So the transitional process is quite cumbersome. People don't want to move on to the e-trade platform because there's a lot of deals going on the open cry. So all that challenge is changing mindsets, introducing to be firm, to have a policymaker that's resoundly supporting a direction forward, and so on and so forth is quite a challenge. So it's very interesting to be there at the ECX right now.
Yeah, and as your personal marketing representative in the United States, I should also like to say that you did $1.3 billion last year. Did you?
Yes,
did you not?
Yes, indeed. So again, early days, not a big size.
And what commodities, by the way?
So coffee makes a significant portion of that, but sesame we do. I just had the Council of Ministers approving oil seeds. So we're going to have a whole range of new commodities moving in. But at the moment, coffee, sesame, white kidney beans, and green mung beans. So these are mandated. Again, the need. In terms of developing, a market in places like in developing countries overall, I think our experience is slightly unique. But we had to get the government to mandate these things in order for us to leverage the liquidity of these trades. So it's only when coffee was mandated to be traded through ACX, then the game started to change. The late Prime Minister Milken was very clear with this that since we supply so much of the coffee, the Arabica coffee, to the world, and yet when you look into the coffee trade overall, there was a lot of challenge within it. The payment structure wasn't there. Default was very high. Supply side, and there was a lot of compromises that were happening. Now we do T+1 settlement. T+1 settlement, we do nearly $10 million a day of trade. So it's a learning curve for us more than anything else. It's been a learning curve. So what we've done very recently is moving on to the e-trade platform. The e-trade platform now offers us nearly 5,000 times transaction capacity. So it's going to be allowing us to introduce a number of new commodities and learning through that process in terms of our capacity as well.
Well, you're putting us to shame with the T+1 for sure. But of course, there's nothing like a government actually mandating that you do something and forcing everybody to do it to get it going, as we all know. Afsaneh, are you persuaded by any of this, either with your World Bank hat on or as your investor, with your investor hat on?
I find this extremely exciting, and I think a huge departure. As Staci mentioned, I had a stint at the World Bank, and hugely admire what Jingdong has been doing ever since there at IFC especially. And then at Rock Creek, we invest in emerging markets, and I also wear another hat where at various foundation endowments, chairs various investment committees. So looking at emerging markets, I just find we've come such a long way, given what Ermias was just mentioning, for example. Basically, I think Jingdong set I think, what for me matters the most. You need the capital markets in these countries to work, because whether the money is coming through the trading schemes into the coffee trading, or it's coming in for foreign direct investments, or it's coming into private equity, or it's coming into the liquid bonds and equities, you need the capital market to work and to have depth and to have the right regulation so that it can do the sorts of things we heard about. The other thing is everyone deals with the very sexy stuff, the investment stuff. They forget that if the operational part and the custody part and the trading back office does not work smoothly and beautifully, the whole thing crashes. And I think what I was just hearing and what Ermias was just talking about is really key to the success of these markets. I think the other thing that I would just want to put in perspective, and Minister mentioned this, is that emerging markets, capital markets have merged themselves a lot. So, for example, in equity markets, we now have about 10% of total equity markets are emerging stocks. That's probably an underestimation, but that's sort of broadly what the total, out of about 35, 36 trillion, about 3.7 trillion is emerging market stocks. And now that excludes, I should say, a lot of small cap and small cap stocks that don't get traded by, and mid cap stocks that don't get traded by MSCI, because some of these are, MSCI numbers. Similarly, bond markets, about 18% of total $40 trillion bond market is now in emerging markets. We just heard about the Argentinian 15 billion bond market. I think a lot of these things are happening because of what the bank did, and especially what Jingdong is doing now at IFC, which is, it's one thing for a country to just go and issue the bonds, but it's having created the infrastructure that allows them to do that. And maybe I'll just stop there.
But let me ask you though, now, when you're doing your perusal of the world,
Yes.
what are you? Who do you think is doing a good job, and why? Or if you don't want to answer that, what are the kinds of things that you look for specifically when you think about where you put your money?
I think for we invest particularly in sort of mainly in the liquid equity and debt markets, and I think it's basically what was very interesting is we all saw emerging markets, especially the last few years, sort of collapse in terms of the returns and huge capital outflows. At the same time, if you remember in January, everyone thought, emerging markets in general are finished, whether it's your country or many that Jingdong works on. And the change in mood was very quick, because I think what was very different is that the structural reforms that usually in previous cycles in the 80s and the 90s really didn't take place, this time did take place. And so in many countries, not all countries, but many countries. You also had the fact that, again, Jingdong mentioned this, the fact that a lot of these countries started borrowing in local currency where there was debt and where that was possible. That was huge. So that when the crisis hit this time round, they were not stuck with the SIN bonds and the SIN problem with the currency issue, having a lot of dollar liability when their assets were in local currency. So that was another very big change. And look at the huge amount of reserves. Obviously, China had the largest with 4 trillion, but other countries, relatively speaking, to their own economies, built very large reserves. So that's also very important for us when we look at countries. The size of the reserve they built, which is sort of like your own personal saving, the fact that they have these savings. So even when there were very big outflows in China, it didn't matter. When there were very big outflows in Mexico, they still had pretty significant reserves. Now, I'm talking more about the positive parts of this. Obviously, not all countries, made the structural reforms that were needed. Brazil, went through this incredible run with commodity prices being high, incredible inflow of assets and of funds that came into Brazil. A huge amount of that got wasted. And now, we're going through political change, obviously, and other things. But while, I have seen more good stories like Rwanda and Ethiopia, and especially Africa, has been an extraordinary story the last 7-8 years, and not necessarily known to the world as much as, Staci, you were talking, and your own work in this area.
Yeah.
But I think it will continue to be in the next decade also a very promising place.
Yeah, but I always say, don't mess with Rwanda. I tell everybody.
But can I say something really? The point that we kept maybe not answering it very well is that we all understand the capital market is necessary. And actually, most of the developing countries, we missed out when, during the quantitative easing, the US was really dishing out a lot of cash. But when it stopped, after 3 trillion in October 2014, even during that time, we couldn't tap as much because we didn't have a well-established capital market. And what that meant is that for us as a country, and Rwanda has also been an example, if we wanted to tap into this money, we had to go to borrow from the market. We issued a Eurobond, which was really highly oversubscribed. But
8
then
times, right?
That's it.
As
8
your personal
times.
marketing representative in the United
8
States,
times.
I will say 8 times oversubscribed.
But we couldn't raise it. We couldn't issue it on our own capital market because it was not well established. And this is happening for many of the countries, is that if we don't really develop our own capital market, the work that you are helping us as a chairman of our capital market authority, and also the work that you are doing for the region to understand the demand and the supply side, is very, very critical for us to be able to build this market. Because once we build it, it means as the changes happen, then we can tap into some of this money.
Yeah.
But it doesn't matter whether the money is available or not available. If our capital markets are not well developed, then tapping it becomes very, very difficult. Yeah. And you saw the usefulness, apart from the normal trading, for the commodities exchange, of course, which you have and which you are rolling out within East Africa. What my colleague maybe didn't mention is that apart from the trade part, is that the farmers will be able to get money once you have the warehousing receipt and you issue it, you take it to the bank and get money without using the collateral. And this is a big deal for the farmers. And if it cuts across so many of them, and these are millions of the farmers, then the impact on their own lives is just incredible. And you can only do that if you have a stock market, if you have a commodities exchange, if you have a market whereby you can issue as many products as possible. I'm glad you're going to derivatives, which is something that is very, very useful.
But Jingdong, it's not just small countries that are not, that are poorer than other countries. You also run into roadblocks in larger countries and richer countries and more emerging markets. And still, though, you feel that sometimes that there's work to be done, and the IFC has done some.
Indeed, I think we, in the recent decade, we have opened about 18 different emerging market currencies, from big countries like China, India, to small countries like Dominican Republic and Rwanda. So let me give you a couple of numbers to show. In sub-Saharan Africa, when you measure the corporate bond stock as a percentage of GDP, the only meaningful market is Johannesburg, South Africa. Outside of South Africa, I think Nairobi and Lagos, are 2 of the more vibrant markets. But their corporate bond market is 1 or 2% of GDP. Okay, compare that to the United States, where corporate bond is over 100% of GDP. South Korea 70%, Malaysia 50%. Just imagine, if you have a vibrant corporate bond market in sub-Saharan Africa, whose weight in GDP go from 1% to 10%, just imagine how much money that could be unleashed. The second story I can tell you is 3 years ago when Bernanke mentioned that word tapering. You had a mini rehearsal of the emerging market currency volatility. At that time, we went to India because India, though it had a capital market infrastructure that was pretty good, but the country's capital market was pretty closed in the sense that the domestic bond market was primarily to satisfy the government's need to finance its fiscal deficit, right? But we went to India. We said, okay, this is a chance for us to help you. And therefore, the government gave us a very unique approval. For the first time in the history of India, they allowed us, an international AAA, to issue offshore Indian rupee bond. We all know dim sum, the Chinese offshore. So they give us $1 billion approval, dollar, And we issued within 6 months the whole $1 billion in Indian rupee out of London Stock Exchange. And government felt, wow, there is demand, although Indian rupee was dropping. So immediately give us another $2 billion US. So to make a long story short, within a year and a half, we literally created a AAA yield curve for Indian rupee, issued over 110 billion Indian rupee out of London Stock Exchange. We built a yield curve from 3, 4, 5, 7, 10, and 15 years. So when the government saw the success of IFC together with central bank, late last year, they actually changed the rules. For the first time, the Reserve Bank allowed Indian companies to start to issue masala bond. This is the name we have given to the offshore. And therefore, connecting international saving to domestic infrastructure financing, but denominated in local currency. So we issued a 10 billion Indian rupee, about 160 million, right, in London, immediately invested in an infrastructure bond issued by Axis Bank of India in the domestic market, back to back, international saving, infrastructure financing. We also issued a green masala bond in London, immediately invested in a Yes Bank green bond that they issued in the domestic market, directly connecting international saving to climate change financing in India. These are the powers. And finally, let me mention China. When we issued Panda Bond, became the first Panda Bond issuer in China in 2005, China's corporate bond market literally didn't exist. Small market of $10, $20 billion. China's corporate bond market now is about $3 trillion. This is not counting, government agency or treasury bond. And this is the power of bond market, especially in domestic economies.
Right. And the only reason that Jingdong likes to do this is because he likes to name these bonds. That's the funnest part of his job, actually. Afsaneh.
Jingdong, I have a question for you. You've done a lot, especially yourself, in these local bond markets,
yes.
Incredible amount. On the equity side, in the other part of IFC, there used to be a lot of emphasis doing the same thing, in the sense of helping to develop the local capital markets so that there would be equity, the same kind of support to the equity side. That seems to have gone away in favor of doing more private equity investing. But for private equity to succeed, you need the local equity market to work, because you still have to come back and sell into those markets. So my sense has been, mentioned India, for example, where, it's very complicated to invest still in equity markets. And you can invest as a foreigner if you're a big pension plan, but then you're not tax exempt anymore.
Right.
Whereas you're tax exempt if you're in the US or Brazil or you're in China. So that has been a huge impediment to equity trading in India. Is there a model where you could extend what you're doing in the bond markets into the equity markets?
So that's an excellent question. I think in the 1980s, early 90s, we did invest in stock exchanges as an equity shareholder. Unfortunately, we probably were a little bit ahead of the time, so financial return wasn't ideal.
Right.
But what we have started to do since then is that, IFC, we have about 3,700 people, of which about 1,500 are on the investment side. But people don't realize we have almost 1,000 people on advisory services. Because we realized for capital market to develop, whether it's equity or bond market, a lot of it goes into regulatory reform, putting in a transparent legal framework. So we have advisory. To give you one example.
A short example.
Yeah. When we went to Nigeria to start, try to issue our Nigerian Naija bond, it took us 4 years. Why? Because in that 4 years, we helped Nigeria SEC to streamline its regulatory framework so it becomes easier for bond to be floated. We helped to reform the pension regulation so pension fund in Nigeria could invest in a broader class of assets. These are the building blocks instead of just investing in the equity stock exchange.
If Staci, the local pension industry is huge.
Absolutely.
You know, we saw with Chile, of course, Chile is the famous local pension story. And as you remember, they were only investing in the local bond market, then they started investing in the local equity market, and then, you know, broadened, as Jingdong said, in other asset classes. And then Mexico kind of followed. And now you have pension funds like in Korea that are like 400 some $billion. You have big pension plans in China. You have big pension plans in South Africa. These are more than 100 billion. In India, of course. So this is, you know, as we were talking about local capital markets, you need foreign money to come in. But when you have the local investors investing, it's key, because local money into emerging markets, as we've seen, inflows and outflows can be quite brutal and volatile. And you need some basic support to the local markets that is constant and there for the long term. And it doesn't mean it's not sophisticated. In fact, it's very sophisticated and long term, versus the foreign money that can come in and out because it's less sophisticated, less knowledgeable about these markets.
Minister, what are you doing in Rwanda? I mean, you've been very focused on cultivating institutional sources of capital in Rwanda, so of savings. So can you talk a little bit about that as well?
Yeah, thank you very much. For us, actually, this is it's like a high jump, because we are relying on the banking system. And the banking system was reliant almost over 80% on deposits. And most of that deposits was short-term deposits, where people can just withdraw anytime. And that makes it difficult for people to lend going forward. We also had the insurance, we had the pension, but they didn't have a way of investing except in the government bonds. And sometimes for them, they could just withdraw anyhow, and that would distort the entire banking system. And now we are introducing, in addition to that, we introduced, of course, a sovereign wealth fund, the Agricultural Development Fund. And at the same time, we are now establishing a system whereby for savings, for the people to invest in education, in housing, but at the same time have a pension for every Rwandan. We did it for health, where we have, for people who are working, are getting deductions for the money on what they earn, but at the same time you have the one for other people who are not getting regular income or no income at all, who need to be subsidized. We are now establishing a system where we can have comprehensive for everyone for the pension. And the resources now will be coming. If these resources are coming without an investment vehicle, without a well-established capital market, with so many products that can absorb this money, then it will become a problem. And that's why they have to go hand in hand. The work that Milken Institute is helping us, with you as a leader, of course, as the chair, in terms of developing a master plan for the capital market development, is really part of this, so that we can now have these resources, but at the same time have a way of investing these resources. And making sure that, as I said, mentioned, opening it up for the entire region so that we are all interlinked and be able to invest not only in Rwanda, but also attracting the money from the region and globally. And this is the only way that this money would end up in development projects in Rwanda, in terms of infrastructure and other areas. So this is really, for us, the way to go.
You know, this sovereign wealth fund that they established, the president said, we are opening this fund and we ask all Rwandans to contribute to it. We don't know what we're going to do with the money. We're just going to use the money for the betterment of Rwanda. And immediately money just started pouring into this fund. And I always imagined, you know, President Obama standing up there in the United States and saying, hey, look, you know, I've got this idea for a fund, right? We're not going to tell you anything about what we're going to do with it, but just donate money and just see how far we would have gotten in the United States. Ermias, beyond just the exchange, do you think of it as a catalyst for broader capital market development in the country? And how do you see the way forward for Ethiopia over the next few years? And you're not, you know, technically a member of the EAC, but it seems to me that you are very much a part of that economic unit. And so how do you think about the regional integration and the like?
Absolutely. I think the capital market is going to be very critical. I think with us overall, I don't know, it's an Ethiopian thing or something, but we're very prudent with the way we want to manage this finance sector. We're mobilizing a lot of local resources. Even I think earlier when you were talking about mobilizing local funding, we did the same thing with Renaissance Dam. It's a nearly $5 billion worth of investment going into the Renaissance Dam on the Blue Nile. It's completely locally funded. So there's that's robustness being built as an underlying infrastructure that we need. Again, I think we're looking at the capacity issue is also a big challenge for us. Again, I said that earlier. It's very, very critical that we build a robust infrastructure. Technically, the regulatory framework needs to be in place. We don't know what the capital market is. I mean, even the regulators don't know it. You know, I learned this every day at the exchange, because some of the things that we would like to do at the exchange, I find myself having to go to the regulator and to teach them, okay, we need to do this, and therefore I need you to be able to help me with this and that. So this is it is a time frame thing. So we're certainly building the necessary infrastructures in place. I think then we have what's called the GTP2 right now, and GTP2 is a growth transformation plan of the government. Is the second phase. It will run for another 5 years, and we've already managed on GTP1, which came to an end last June. We managed to build a saving rate from 5% or below 5% to 20+%. Again, this was all, it's all local resources. So saving schemes of all kinds through the mobile, through the banking system, housing schemes. I mean, if you come and see this is, you've seen last time.
It's amazing.
So it's totally incredible, because you will imagine that in the absence of a well-developed capital market, where is all this money coming into Ethiopia, and all this construction. The road construction, as you've seen, is we have the first toll road in Ethiopia. It just launched about 6 months ago, and it's now a big success. So we have new toll roads in the pipeline, bridges. And overall, I think it's a journey. For us, it's a journey. How soon is the question we have to be answering.
Yeah, but don't think that I haven't noticed that you haven't answered my regionalization question.
I think we envy Kenya, we envy Rwanda and Tanzania. I think there is a connection that we see. The fact that there's a language connection, there's a fairly well-developed market in Kenya that we've been envying over the years, and so on and so forth. And I think Ethiopia is kind of sits in this corner. It's a very unique place. At the same time, we have over 80 languages spoken in Ethiopia, different tribes. It's a big country as well.
Right.
So I think regional integration is key, but I think there are a lot of home issues we need to sort out first, and I think that's where the focus is right now.
Okay.
Thank you. For the credit of Ethiopia, we've been holding meetings within the East African community, especially the northern corridor part, where the Rwanda, Uganda, Kenya, South Sudan, and Ethiopia actually has been coming as a member, trying to observe and really trying to be part of the process. So as you said, it's a journey, it's a beginning, but I think there is progress that is being made, which we very much appreciate.
I'd like to open it up to the audience, because I know folks have a lot of questions. I do also know some people in the audience, so I will call on you. And Eric, I was going to call on you anyway, so I might as well start with you. Eric, former chief economist of the EBRD, so has and now at the London School of Economics. So please, I'll collect a couple of different questions at once, and then.
Thank you, Staci. I had a comment and one question. So, indeed, at EBRD we worked a lot on this, and we worked a lot with the IFC to try to push this process forward. But no one has really talked about what we found to be the main hurdle was really, the macroeconomic stability. I mean, there's a reason why people go into dollars and why local currency is expensive. The other thing, which is of course very closely related, is the stability of the banking system. If you don't have functioning banks, it's very hard to get these other markets going, but they are really typically the market maker. My question was, I just came from another panel which was talking about the role of fintech, and it was a lot of focus on what's happening to the big guys on Wall Street and so on. How do you see fintech having an impact and maybe helping you develop these markets? And I say this against the background. I've been part of a group that's working on this, and it's very striking that people are so focused on the risks now and not on the possibilities.
Yeah.
That's what I wanted to hear, how you see it.
Yeah. Ruben is the dean of the Elliott School at George Washington University, Elliott School of Foreign Affairs. Actually, maybe I'll have everybody introduce themselves because I don't know everybody in the room.
Thanks, Staci. My name is Ruben Brigady. I'm the Dean of the Elliott School of International Affairs at George Washington. I'm also the immediate past U.S. Ambassador to the African Union. Very briefly, 2 questions. First, for His Excellency and for Ermias. Can you conceive of a pan-African capital market for all of Africa that would be able to sort of generate capital on a much broader scale and also support the program for infrastructure development? And then for all the panelists, I haven't heard you talk very much about the legal frameworks that are necessary to underpin these sorts of capital markets, particularly in developing countries, frankly, where rule of law may not be as strong as more developed markets. Can you please talk about that? Thank you.
Okay, any other questions? I'll take 3 for round 1. Yep. Yep. Oh, I'm sorry. Manuel.
Yes. Good morning. Miguel Azevedo from Citi. Just a quick provocative question here. I basically agree with your analysis, but isn't Ethiopia the less developed capital market in the eastern part of Africa, the one that is doing right in terms of infrastructure financing? So is this a paradox, or is just a coincidence?
Okay.
Where obviously the government is taking the leading role as opposed to capital markets themselves.
Yeah. Okay, Matt, why don't we just collect from you too, and then we'll.
Yeah, Matthew Reese with Geonomica and the Financial Times. I wanted to ask just a question about sort of developing the SME sector and access to credit. The World Bank's doing business rankings has Rwanda is ranked 2nd, I think, globally in getting credit, and Ethiopia is ranked 167th. Can you perhaps talk about maybe with respect to both Rwanda and Ethiopia, where you see the gains that have come from making credit more easily accessible, and the obstacles in Ethiopia, and then Jingdong, if you have anything to say about those rankings more broadly and the significance for developing a domestic business sector.
Okay, Rwanda, as you know, is very angry about their number 2 ranking, and they're trying to do something about it next year for sure. So let me just quickly summarize, and then what I'll do is I'll just go down the line, and people answer what they want to and feel comfortable answering. So the importance of macro stability as well as the stability of the banking system, and then why can't you and shouldn't you be focused on some of the leapfrogging opportunities with fintech, and how do you think about that in terms of your overall capital market development plan? Let's take regionalization to a Pan-African level. Is that possible? Could a Pan-African legal framework work to make a one big, and then you'd get your economies of scale? The EAC, for example, is a $135 billion economy right there. So can we encourage even at a larger scale? The irony, perhaps, that Ethiopia has done the most to marshal what is the most intractable problem in finance, infrastructure finance, but does have the less developed capital markets. And how is that? And are there lessons there? And then the ranking question. And so are there lessons from Rwanda that could apply to Ethiopia? And is there a way for Ethiopia to take some of those lessons and move forward? So why don't I go down the line? Ladies first.
Thank you. So a lot of sort of different kinds of questions. I think on the macro one, I'm really excited about the question on fintech, and I think we talked about some of the things that are going on in Ethiopia and Rwanda, but elsewhere. I think what we saw with emerging markets is that in some ways, by not having developed markets in certain areas, it allowed them to leapfrog. Those of us who are old enough to remember about mobile phones versus the old phones. Remember all the money that the World Bank and IFC spent in getting telephone systems and telecommunications, and how that did not go very far, and then mobile phones came in and totally changed the picture in emerging markets. I think fintech will be another example. We've seen already things like mobile banking ahead of the US in many emerging markets, of course ahead in Europe and Eastern Europe. So I think going to that specific area, fintech will be an area where both collection of funds and disbursement of funds. But it will take us back to what we heard, there is no proper legal regulatory framework yet for even peer-to-peer lending here, let alone going into emerging markets. So these things will have to go hand in hand, and I think some of the multilaterals like IFC Bank will be helpful, and universities in terms of creating, helping to create that infrastructure. I think when we talk about things like why and we have experts who know much better about Ethiopia and Rwanda here, but the reason that some countries go down the route of using local assets, local funds, is not because they wanted to in the first place, but because they didn't have access. So there is a question of access. And I think what we're talking about is that basically the capital markets internationally are looking for opportunities. But at the same time, one area we haven't touched on is the whole area of social impact. So if you go into JP Morgan, you go into Morgan Stanley, they're getting Fidelity, Vanguard, they're getting huge amounts of assets come in there for social impact. People who are looking for some sort of return, but also are very interested in social impact. There's no connectivity that I know of between those huge pools of assets who are in fact looking for the kinds of opportunities we're talking about, and the local projects, and providing some sort of connectivity. What are the list of projects for climate change or not for climate change? Mm-hmm. As we're sitting in this room, Jingdong and I were just talking before the session, the Paris Global Borrowers session is going on. That's sort of a meeting of all the borrowers, big borrowers in the capital markets that get together once a year under the auspices of World Bank and some other countries. And it happens to be in Paris, very fancy. The big topic that they're discussing right now is the whole issue about climate change and getting resources through the capital markets into financing of capital markets. So I think that together with the fintech is going to be really exciting areas, and particularly exciting in the smaller countries with less infrastructure, who's starting with absolutely nothing. So I'll just stop there.
Okay, terrific.
I think I just wanted to maybe touch a little bit of the reason why maybe in our case in Ethiopia, why the banking sector seems very risk averse. I think the way we are looking at the finance sector is we're dealing with really very poor people's money, and is a money that's not easy to replace. So the overall infrastructure, the regulation, and also opening up the various sectors for the finance sector has been an issue of contention. I remember some 20 years ago when I was in college, even World Bank and IFC was insisting on Ethiopia to open up the finance sector, telecom, blah, 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 otherwise the economy will never go anywhere. Now all of a sudden there's always a reflection of different kind. But why I'm saying this is I think it's for Africa especially, I think our issues are very complex. Ruben, you've been very well, the Ethiopian setup, but the complexities and issues that we deal with every day and the way we need to untangle it is very complex. I very much look forward to a Pan-African exchange. I get, we have a relationship across Africa from Kenya, Tanzania, we get from Nigeria and so on and so forth. So there is that, that destination somewhere, but the problems within is very complex. This is, at the end of the day, all African people have to live out of what they do every day. So trying to champion an exchange or capital markets of this kind, this is not going to be very easy. We need to make sure that it works for us and it works for everybody else. But certainly it's an idea on the table. We might be starting a sort of an exchange association of some kind early on, but it's very much there on the table. I think we as an Ethiopians, we feel some of the things that we've done. It's been very interesting. It's all local resources mostly, and we only managed to raise some Euro bonds for $1 billion or so. That was some 6 months ago. So the level of dates, is very low in my judgment. But I think looking at the opportunity in Ethiopia, as a banker too, I know very well the level of risk when it comes to FX settlement and the trade balance is always a challenge. I mean, every day we're dealing with issues of, we're importing diapers to needles, medical equipment, blah, blah, blah. How are you going to keep the FX balance when you have 100 million people that you have to take care of every day? So, yes, when you welcome that capital into the country, you have to be worrisome of how you make sure that your repayments will also work. When we had Heineken, I was privileged the Heineken banked with my bank when they started, and so on and so forth. So, but the problem is when it comes to repatriation, it was always a big question mark. How do we do this and how do we do that? So I think my caution is prudence. I think for Africa, we've seen what Argentina went through some 15 years ago. The risk in Africa, the stabilization, the security issues, all of these things are super, super sensitive. So as, to keep the balance of social life, infrastructure, very, very important. Young people, we have some 60% of Ethiopians are under the age of 25. So you really have to keep them busy and so on and so forth. So,
Minister,
thank
young people
Thank
busy.
you very much. Really, I think the question of macro stability is very important. And for Rwanda, we really don't take it lightly, because this is the basis that has helped us actually improve even our business conducive environment. But what we see in terms of course, everything has been done. We are a low debt country. Our inflation has always been below 5%. We are a country that is rated B+ by Fitch and S&P. So we've been really trying to make sure that the macro stability remains. Not only the monetary side, but also on the financial side. We have been a country dependent on the banking system. We have, together with the support of the IT system, we have been able to make sure that the inclusiveness really becomes real. We introduced the whole entire banking system to almost every corner of the country, but also ensure that the IT system allows the free movement of money. I remember when I started in the central bank in 2009, the amount of money which was outside the banking system compared to the broad money was 28%. But now it has come down to 9%, meaning that actually this time we had to move from monetary aggregate model to now inflation targeting to make sure that actually moving to inflation targeting, you can do the monetary policy much easier because the money is in the financial system. That's the time when we started actually, not only because of the system, introducing the cards, introducing mobile payment, introducing agency banking, and now the mobile is almost I would say the store for any kind of anything that you want to do. It's a banking system for any movement of any resources, which has been very, very useful for Rwanda. And our own banking system is one of the most strictly regulated because we conform to all the Basel principles, Basel 1, Basel 2, Basel 3. Our capital adequacy ratio for us is 15%, but now it's 24% on average for the banking system. The liquidity ratios, which is the minimum of 20%, for us it is about 40%, really showing that it is highly liquid. But also the non-performing loan is 6%, meaning that we have actually been successful in that area. But of course, we have also introduced the capital liberalization. You take out any money you want, anytime. There's no restriction of any kind. And we are saying that we are going to contain that by making sure that we maintain the macroeconomic stability. And this has worked for us, but that helps in terms of the foreign direct investment. But when it comes to capital flows, and that's why we are coming to the issue of saying it doesn't matter how the goodwill is for the government. It doesn't matter whether people want to invest. Not everybody is going to invest in a company. They all want to make sure there is a market. And that market is the capital market which we are trying to build with the assistance of the IFC, with the Milken Institute, that is helping us to say, in as much as people want to do it, but where is the market? How do we do it? And that's the vehicle that we are looking at in terms of building in Rwanda, but also in the East African Community region. And this comes back again to the Pan-African one. I think what is possible is starting with the region. Each, for example, in the African continent, we have the blocks. We have the East for East African Community. We have SADC. We have the ECOWAS, which is in the West Africa, and the rest of it. So starting from the region, not only building the capital market, it is also the integration. That's where it starts. And with that integration, it should go with the capital market integration. So that way then, eventually, we can come to Pan-African market, but having linked with the regional one, because they know each other very well. And this helps, and that's what we are doing in the East African community.
Okay,
Could I just,
let me,
sorry.
no, go ahead.
I think the only thing I was going to say is we started an Sub-Saharan Africa fund, and we had to limit it. There was so much interest, but we had to limit it exactly for the reasons you said. The size of the companies, there were not enough size of good companies, but also if they had been regional, there would have been the sort of the leverage effect.
The scale, Jingdong.
Macroeconomic stability, absolutely. When nominal interest rate drops within single digit, interesting things happen for private sector because cost of borrowing would have come down. But paradoxically, the strength of the banking system is also related to having a vibrant capital market, because then banks wouldn't have to lend in riskier assets, which should have been the job of capital market. Pan-Africa, I am pessimistic. I'll be very frank with you. I was part of the secretariat when I was in ADB, Asian Impact, for Asian capital market integration, right? So ASEAN is the right model. That is, one Korea company can go to Malaysia and issue ringgit, can hedge, can go back, but having a single market denominated in whose currency, that's much more controversial. And let me be very frank. That is, when you look at the two CFA zones of Central Africa and West Africa, we have been trying for many years. We haven't got anything done in terms of issuing corporate bond, because once you have a regional decision body, the time takes is much, much longer. And the government of a domestic, a sovereign would lose their own ability if they can move very fast. So I think I would express a bit of caution there. Ethiopia, to be very honest, I have been traveling to Ethiopia, talking to finance minister. Ethiopia is very similar to China, maybe 1980s China. From an ideological point of view, they have not been there because it took China from 1979 to the mid-1990s when China started to recognize the value of capital market, right? But the counter-argument, I would say, is that if you learn from all the crises, right, instead of also appreciating the powerful positive force of capital market, then the country would undershoot its potential. One would say, oh, look at China, you have a corporate debt problem. It's a corporate debt problem. Now China's per capita GDP has reached $10,000, right? Because capital market has already played a very positive role. So I think that is the kind of argument. Don't let crisis stymie the potential. Yeah, if you don't do anything, obviously it's fine. But I think your economic activity will stay at a lower level. And to unleash private sector entrepreneurship, China came from a communist system to now recognize the centrality of private sector. It took 30 years, but China's private sector, is 60% of GDP, employs 80% of people. And that's the power of private sector. Hopefully, one day Ethiopia will get there. And what I have to say on the positive side, both for Rwanda and Ethiopia, is that it's not only governments that recognize the centrality of development, but the ability to execute, right? Meaning these are the really some of the good examples. But it is true that on doing business ranking, because Ethiopia has not been a private-centric model yet, that's why the ranking is much lower. And I hope, with the support of, international community and, your leadership, we can lift it up just as Rwanda has done.
Okay.
Thank you.
So with no further ado, my only instructions as a moderator was try to instill some controversy on the panels. I've failed miserably at that. I think we all see the world pretty much the same way and the way forward. Just a shameless plug to please come to our speakers reception tonight, where we will be announcing a very exciting program that we're doing together with the IFC and George Washington University to take developing capital officials from the various capital markets institutions in developing countries focused on Africa this year, bring them to the United States for a semester of coursework and then an internship, and then unleash them back to their countries to help foster some of the things that we've been talking about up here on this panel. So thank you very much for coming, and we'll enjoy the rest of the conference.